This is the Keiser. Hello there, I'm Max Keiser. This is the Keiser Report. I'm here with Stacy Herbert. We're going to be talking about stuff. Stacy.
Max. So you know what happened this past week?
No.
Amazon went through $1,000 a share.
Right.
That was big news. Apple is close to that. Apple is heading towards $1 trillion a share. I remember with Michael Pinto when we were in New York, you spoke of the FANG shares. Sure. Well, everybody's talking about the FANG shares now, except for now it's also the FANG shares because you have to include Adobe, ADBE, on this ticker tape. They're up 38% so far this year, and AVGO, which is Broadcom, another tech company, and that's up 36% this year. So now they've come up with a new acronym, and it's FANG.
Well, I mean, these are platform companies. Amazon is a platform, Facebook's a platform, Google's a platform, or Alphabet as it's called now. So they own, Facebook's got 2 billion users, just about. So it's bigger than any country in the world. And they have, I see Mark Zuckerberg wants to do universal basic income. He supports that concept. And I'm pretty sure it's because they want to be the company to distribute the universal basic income to all his 2 billion users. And of course, that would bring him in another 2 billion users. And so they're worth 400 billion, 800 billion, $1 trillion in market cap. But I've been saying now for 5 years that there's no reason to think these companies are not going to continue to go higher. I mean, by the standard measure of valuation, they're at the top end. But you can't use a standard measure of valuation because of the dominance that they have, more than any monopoly of the past, more than Standard Oil, more than any dominant monopolist that was broken up during the robber baron era, U.S. Steel and others. These are much more dominant. They're global, and the cost of scaling, you don't need to pay high-priced workers. You just need to get another server. That server can handle another million users, and so the economies of scale. Apple profit margins are still in the 60%, I believe, for these phones. And that is an unbelievable margin. Compare that to a grocery store where the margin might be at most 1%.
Yes, that's with Walmart. It's about 1-2%.
Margins are 1-2%. Amazon, the margins are incredibly higher because they have Amazon Web Services, which is online cloud servicing. Again, the margins are spectacular. So you can't look at the earnings. The earnings are whatever Jeff Bezos wants them to be at any particular quarter. That's true of any CEO of any Fortune 500 company. And they don't like to pay taxes, so they tend to understate earnings. And so they've got room to go until such time as something else comes along to compete for the investment
or
dollar.
unless something comes along like a real Teddy Roosevelt to break up these monopolies, because they are monopoly, oligopoly positions, and they are able, we've covered it, for example, that Facebook and Google stays Google for this purpose because of the fact that without a G at the end of, we would have no FANG, we would have fan. So we keep the G for Google. It is Alphabet now. But Facebook and Google capture almost all of the new growth in advertising revenue. So at some point, some administration, some legislator might come along and try to break it up. In particular, if there's a competitor in their district who is against these monopolies.
Well, think about the empire of Rupert Murdoch, who shrewdly bought media companies and newspapers to influence politics in the United Kingdom. He gave us Tony Blair. And Tony Blair gave Rupert Murdoch billions and billions of dollars of monopoly franchise value. Now, look at Facebook. Facebook filters our news. So, yeah, there could be an attempt to break up a monopoly, but who's going to know about it? And they get their news from Facebook.
Well, look it up. I don't have all the details here, and I don't have the headline here, but Sheryl Sandberg was found in Ireland. I believe there was some information that came out that she was speaking to ministers there, that she basically helped them pick the person to be their information minister, the person who would be in control of any data retention policies.
Well, it's no accident that companies like Amazon and others are talking about building settlements on the moon. In other words, they see Earth as having been conquered. They already own Earth. Amazon owns Earth, everything from A to Z. If you look at their logo, the arrow goes from A to Z. They own it all. They get a commission on everything. And Alibaba, of course, is a competitor, but they have a duopoly, essentially, in the globes e-commerce business, but they consider Earth to have been conquered. We are slaves now on Earth to these companies. They're looking at other planets to go after, other satellites, other moons. They're going out into the solar system.
Yeah, but I did see Josh Brown, downtown Josh Brown, a reformed broker on Twitter, tweet something along the lines of, Jeff Bezos says, let's go to the moon. The Tesla guy says, let's go to Mars. And Warren Buffett says, let's buy Pepsi. So he is quite earthbound and yet quite wealthy. Jeff Bezos is wealthier. But I want to turn to this headline from Zero Hedge because, the NASDAQ has quadrupled since the 2007-2008 crash. It's now past the 2000 highs. You were there for the first dot-com boom. So now, of course, we've already covered everybody's calling for a crash in the Dow and the S&P 500, but now people are starting to look at the NASDAQ and see whether or not we might be in tech boom 2.0, dot-com boom 2.0. And that is the first crack appears in the second tech bubble. So Zero Hedge is already declaring it's a tech bubble. 4 weeks ago, Goldman pointed out that in 2017, just 10 companies are responsible for half of the S&P's rally year to date, with the top 5, Apple, Facebook, Amazon, Google, and Microsoft, have accounted for nearly 40% of returns. A few days later, then Bank of America showed that annualized tech inflows are now the strongest this century, running at an unprecedented 25% of AUM, which is funds under management, which Bank of America dubbed a sign of renewed exuberance.
Right. It was only maybe 3 years ago that the biggest company by market cap was ExxonMobil. And it was big news when Apple overtook ExxonMobil in market capitalization. And now I think 4 or 5 companies have overtaken ExxonMobil in terms of market capitalization. And you still have huge continents to conquer: India, China. These are huge populations, Indonesia, that will be succumb to Amazon and Google and Facebook. And the margins are high, and the ability to scale is virtually infinite. And the management teams are the best that we've seen in 150 years in America. You mentioned the dot-com boom and crash. $5 trillion got wiped out. There were a few survivors. Google, you had eBay, and 3 or 4 others went on to become now close to trillion-dollar companies. Apple Computer, although it's not really a dot-com. And so this is a phenomenon that will continue to percolate. As far as cracks go in the facade and where is this a crash material, of course, it is overdue for a pullback for sure. But there's no other game in town. Where are you going to put your money? Gold and silver have been flatlining for half a decade.
Yeah.
Bitcoin in cryptocurrency, it's a $60 billion market versus Apple's $1 trillion market cap. Sure, it'll go to $500 billion soon enough, but probably not enough to knock Apple off its perch. So where else do you go?
One thing to look at is the article in Zero Hedge points out that not in a decade have the multiples, the PE multiples, been so high on the NASDAQ. But of course, I think a lot of people forget that the dot-com crash wiped out a lot of money, and people learned the lesson for a genuine generation, unlike the subprime mortgage collapse, which a lot of investors didn't actually lose any money because they got bailed out. In 2000, they didn't get bailed out, and those people have stayed away for so long for real because they didn't want to get burnt again. But now, as I said, the assets under management, this is a chart they show that the tech inflows are the strongest in 15 years. So, all through this was all during the subprime, the housing bubble, the last housing bubble. Now you see that it's soaring. Everybody's pouring all of their money into the tech sector. Of course, Warren Buffett, as I mentioned, has become a huge investor in Apple after decades of not participating in Apple.
Yeah, I wonder what Carl Icahn is thinking, because he sold Berkshire Hathaway / Warren Buffett their stake in Apple. Came from Carl Icahn, for the most part, who had made a big score on his Apple stock, but has given up huge upside. I wonder if he regrets that sell decision. He was also at that time talking about a crash is imminent, markets are overvalued. This is how it works, Stacey. Stephen Cohen, who had the SAC fund, I believe it was called, they got in trouble, they shut it down, people went breaking the law, some folks went
Insider trading.
Insider trading. Stephen Cohen, the guy who ran it, was untouched. He's coming back into the market with a $20 billion hedge fund.
Yeah, in 2018.
Right, and he'll be buying these stocks to riding the momentum.
Yeah.
And so if you're not going to apply any rules of law to financiers, to hedge funds, and it's completely open season, and you have a few oligopolists who can scale virtually without any cost, you're going to have these things continue to race ahead. And eventually, yeah, you'll have a correction, but...
Yes, for every buyer, there's a seller. And as we're saying, the assets under management, all the smart money is pouring into the tech sector. The NASDAQ is hitting all-time highs. But this is with the crack that Zero Hedge is talking about are the ETFs, the tech ETF, the tech sector ETF. So as the chart shows, investors pulled more than $716 million from the most popular technology exchange-traded fund last week, the $17.4 billion Tech Sector Selector SPDR Fund, or XLK. It's the largest weekly outflow in over a year. You can see that these were the sellers. The buyers were the likes of Warren Buffett. So one of them is going to be wrong ultimately. Maybe they were calling the top. Who knows?
Well, ETFs are a derivative. It's not the actual stocks themselves. And there are more ETFs and derivatives than there are stocks. So the action amongst that derivative market is huge. There's hundreds of trillions of dollars in derivatives versus, it's a 50 to 60 times bigger than the actual physical / stock market. So again, it's hard to extrapolate a lot of meaningful trends from that kind of whipsawing in a derivative market when you have the fundamentals, if you will, of this tech sector impacted so profoundly by the fact that company like Facebook with 2 billion users heading to 4 billion users, Apple Computer, huge gross profit margins. I mean, this is a new world, essentially.
It's also a new generation, Max. So many people out there watching this won't have been even maybe born in 2000 when the dot-com bubble crashed. So they're talking about how high the multiples are now, and it's like 24.4. Of PE ratio. I'm sure you remember when it was like 240 was the average PE ratio.
Well, the dot-com height, it was almost 100 amongst a certain group of stocks. So you got a lot of room there. I mean, it could double from here before you get to the old valuation, according to those numbers.
Yeah, and of course, into that is a new generation. As I said, we're in a new generation. They're exposed to the crypto market. The crypto market is now merging with the tech sector. These are also companies that could be IPOing if they feel like no longer ICOing, which is initial coin offering. So there's a lot of money out there, a lot of new billionaires, millionaires, 100 millionaires from the Bitcoin, from the Max Coin, from the Ethers, there are hundreds of cryptocurrencies out there and thousands of new millionaires to invest in this sector as well.
Let 10,000 billionaires bloom. All right, well, we got to go to the second half after the break. Don't go away.